guys, so this is quick revision part 2. We have already seen up till engagement of the auditor in the last session. So in this session we will be going to see the quick revision of the further steps. So this is the scope of this session 315 part 1, that is obtaining the knowledge of client business. I'm going to take you through that. Then 300 and 320, which is on planning and materiality. We will also then look at the balance part of 315 as to what we are supposed to deal with it once we've already dealt understanding and assessing the risk, and then we will also move about discussing compliance procedures and substantive procedures. So hell a lot of things to do in this session. Alright, let's get up, and I hope from the last session everybody has understood what range of speed is required in terms of a quick revision. See, because the very idea is once you know all the topics, this particular video should be a great help for you to revise everything very quickly, right? Moving on to the beginning, I want to take you through quickly once again to what is called as the audit process. Let's look at what audit process is all about. So we have already seen engagement of the auditor, which is what was spoken in standard number 210 pretty clearly. We discussed in the last session, and also we have discussed certain quality control aspects. But then before we go to formulation of the audit program, I think these two, which are called as the preliminary engagement activities, right now I think we have to go by this here, obtaining knowledge of the client business, standard number 315, and part 1 of that will speak about it. So that's it. That's what we ideally are looking at trying to do. We will do one thing. We will go ahead and we will see what we can do to obtain knowledge of client business. 5 very simple points to start off, guys. So obtaining knowledge of client business as part of standard number 315. So this entire set of understanding the entity and its environment, that's what the crux of 315. If you have constantly observed what 315 has always spoken about, 315 has been a 3-part standard. Part 1 is about understanding the entity and environment. Part 2 is about understanding the internal controls. Now if you have done these two clearly, then we will be going about doing identify and assess the risk. Identify and assess the risk. This is exactly what we will be doing in terms of our understanding with respect to the 315. There's 2 parts to this standard we will deal later. Right now I'm going to take you through the 5 points. So whenever you start off the audit, all you need to do is to have a correct understanding of your client, for which first you need to understand to which relevant industry do they belong to. What are the regulatory and external factors? Now, because regulatory and external factors, these change from industry to industry. There is always a set of rules that apply exclusively to one particular industry, right? So that is exactly what is supposed to be understood by the auditor first. Like, what are those laws and regulations that are applicable to my client? Does my client belong to real estate? Does my client belong to software industry? What is the industry that he actually belongs to? That's the whole point. Relevant industry, regulatory and other external factors. If you have understood that, then we have to understand broadly a very important umbrella term. When I say umbrella term or omnibus terms, these are certain things which have deep meaning inside, which is what is called nature of the entity. Now, how do you understand the nature of the entity? Nature means what is the entity all about, what is it doing, how is it doing. So these are some things that one needs to understand about the nature. Nature of the entity, including its operations basically to understand what they do, where they get their money from. Ownership and governance structure, this is more to understand somebody who you have heard as TCWG. A clear split between who is TCWG, who is management, and who are the actual owners. So owners, regulators, TCWG is something that we need to have a perfect clarity on, because what is the structure, the overall, like you've seen organization structures and management, like likewise here you need to understand who's having that ownership and what is the governance structure. Once you've taken care of both these, then what type of investments have they made? What type of investments have they made? The type of investments that they have made, and of course the type of what type of investments the entity is making. Because if you have made investment into another company in which you hold more than 51% stake, now they can all become your subsidiaries and all that. So therefore you need to understand what type of investments did our client make. Is it a long-term investment, or is it an investment which is current investment, which is set to be sold within 12 months? So what is the investment that our client made? Operations, ownership and governance structure, the type of investment made, the way entity is structured, that is their organizational structure, and how it is financed. That is exactly where we talk about debt and equity. So here, you know what exactly are we taking into consideration. So are we solely financed by debt, which is a too risky thing? Are we solely financed by equity, which means we don't have any debt advantages? So considering all this, these are some of the points that we need to take into our consideration. Moving further, every entity's selection and application of accounting policies, that will differ. Entity's selection and application of accounting policies, which will vary from entity to entity. Therefore, it is very important for us to understand this context. In this particular case, what did our client actually do? Not only that, the entity's objectives and strategies, and those related business risk. See, every entity will face a risk that they may not be able to achieve their objectives, and since in this particular case we're talking about they may not be able to achieve their objectives, that is exactly what we're counting as the risk. So what is the objective and strategy of your client, and what are the hindrances in achieving those, like what associated business risks are there in that, is also something that we need to understand. Then after these are done, you will measure the entity's financial performance. Now you can use ratio or trend analysis to do this, because what happened in the past, you can take the last few years balance sheet and try and understand, and then go by dealing with it, right? Industry, regulatory and other external factors, the nature, like you can understand the operations, ownership and governance structure. Then you go by the type of investments that have been made, and the way entity is structured and financed, to understand the nature. Relevant industry, nature, entity selection and application of accounting policies, the objectives and strategies of their entity along with their associated business risks, and the measurement of financial performance. I hope things are going good, and that's what we have in the understanding of 315, which is now being speaking about the knowledge part, obtaining knowledge of the client's business. Then moving further, herein we are going to talk about, so these two steps right now have been taken care of. So right now, very important step wherein we are going to talk about formulation of the audit program, wherein we have to have the complete understanding of standard number 300, and then of course I will take you through some of the important points with respect to materiality. So let's revise those two standards, standard number 300 and standard number 320 on audit materiality. So moving further to standard number 300. So this particular piece of standard number 300, which is on planning and audit of financial statements. Now, before I go to understand, let you understand what this is, let me give you a quick framework. I want you to see this right in here. All we're trying to understand is make us comfortable in doing some things that we actually are supposed to. Like say for example, herein we talk about standard number 300. Standard number 300 is framed in the context of recurring audits normally. Framed in the context of what? Recurring audit. At the same time, standard number 300 also identifies certain additional considerations. It identifies what? Additional considerations, and that for initial audit. This is where you take up the audit for the first time. Got it? So if you do these two breakups, you know what you will be actually doing. Now what happens is, whatever we do in recurring audit, this side will be done here in the initial audit. So recurring audit will, all activities done in recurring audit will be performed in an initial audit, plus you will have these additional considerations to take care. And looking at what we will do in recurring audit, they're again broken down into two. Recurring audit is talking about this one, preliminary engagement activities and then planning activities. Okay, as part of planning activities we have two, that is establishing overall audit strategy, and developing an audit plan. Now that's exactly what we have to try and understand in doing this. Okay, so this is the broad framework, guys, what you see there, standard number 300. So if you're carrying a notes right now, see, whenever you're finding certain things important on screen, it's always good to make notes. If you haven't made one before, if you already have one, you're cross-referring that, it's amazing, right? So in standard number 300, we're talking about recurring audit, and in recurring audit we'll do two things. One is preliminary engagement activities, and two, planning activities. Now we'll get to that. First, preliminary, before even we commence anything about planning, first thing that we need to do is to have an understanding of the continuance of client relationship. Now, why are we using this term continuance? Because you already have a established relationship. This is in case of a recurring engagement, right? So we use the word continuance of client relationship. And in my last segment towards the end, I already discussed about quality principles in standard number 220, right? Acceptance and continuance for the client. 4 points we discussed, right? That is exactly what here they're asking you to check. The integrity of principal owners, competence of our own team members. So these are all something that they want us to actually check. So continuance of client relationship, that's point 1. Then 2, ethical requirements including independence, which is also the part of 6 ethical requirements: integrity, objectivity, independence, professional behavior, professional competence, and maintaining confidentiality. 6 ethical principles they've asked to check, and we did do that in 220 in the last segment, right? And not only that, understanding the terms of audit engagement as per standard number 210. So if there is standard number 210, all I want you to do is to have a understanding of the complete terms before even you start the planning of the audit. So once again, standard number 300 is about planning and audit of financial statements. And now that you're planning an audit of financial statement, you are expected to plan it in proper context. So wherein you talk about recurring audit and also initial audit. So that, keeping that in mind in that context, you need to understand what are we doing here. We are doing preliminary engagement activities and planning activities. So I hope you got part 1. Let's move on to part 2. So part 2 here we're going about 2 things: establishing an overall audit strategy and developing audit plan. Now these 2 put together here, these are called as planning activities. Planning activities. I hope you have a clarity on what you're supposed to do. Now guys, this one, the establishing overall audit strategy, that alone has the potential to come in the exam for a separate question. So I want you to concentrate on this piece. So what are we doing while establishing an overall audit strategy? While establishing an overall audit strategy, it is important for us to identify the characteristics of the engagement. Identify characteristics of the engagement and define its scope, because from engagement to engagement it differs. So all I want you to do is to identify the characteristics of the engagement and define its scope. Ascertaining reporting objectives. Ascertaining reporting objectives, because at the end of it we need to know what exactly are we reporting about, right? So if you at the planning stage only know that it is important for us to at this stage only we have to discuss the fact that what is it we have to ultimately report, because after doing the entire work suddenly you realize that okay, this is not what I work for. Doesn't make any sense, right? So ascertaining reporting objectives of the engagement to plan the timing of the audit, and nature of communication required. So what is the first thing that we discussed here? What are the characteristics of engagement? Because they change from engagement to engagement, we need to identify the characteristics of engagement and define its scope. Ascertain the reporting objectives of the engagement. Ascertain the reporting objectives of the engagement and nature of communication required. Now there may be several factors that you consider the past, right? Consider the factors that are significant in directing the engagement team's efforts. Now as an auditor, it's very important for you to channelize the efforts of people, right? Okay, so consider factors that are significant in directing the engagement team's efforts. And not only that, ascertain the nature, time and extent of resources necessary to perform an engagement. Ascertain the nature, time and extent of resources. This is not NTE of audit procedures, guys. This is the NTE of the resources required. Ascertain the NTE of resources necessary to perform the engagement. And whether knowledge gained on previous engagements. So if at all you have gained any knowledge from previous engagements, if you have worked here as an internal auditor, or you have rendered some assignment, or you have some association with the client in the past. So did we or do we gain any knowledge of that past? Whether knowledge gained on other engagements performed are relevant is something that we also need to understand. This is the consideration of establishing an overall audit strategy. Answer the question of what to do in the audit. It's a very important part to discuss, what to do in the audit. Okay, so identify the characteristics and define the scope. Ascertain your reporting objectives. Consider what you are supposed to do to direct the engagement team's efforts, and ascertain the nature, time and extent of the resources required. How many people are required? Are they less in number, more in number? What is it all about? And then you also need to consider whether the knowledge gained on the engagements that you did in the past, are they of any use to you? Now, if you have done all of this, developing an audit plan is actually very simple, you know. How do you do the audit? Develop an audit plan, they're telling. How do you do that? Simply follow standards, right? You just have to follow standards on auditing. But if I have to tell you very clearly, follow standards, a very blanket answer. So if we have to make it more elaborate and content to make it understand, what we are supposed to do here is break it down. First, what are you doing? We're doing risk assessment procedures. As you go by the previous part, we did no. So after obtaining knowledge of client business, first you're doing planning. That is wherein you do all the planning activities required to perform risk assessment procedures. Once you perform risk assessment procedures, you will have an understanding of how much risk is involved in the organization. Now, once you know how much risk is involved in the organization, you will again see what controls have they established and obtain an understanding of controls. That is where in 315 we do a risk control matrix. What is the risk? What is the control required versus what is the control applied? Now, if we have a thorough understanding of this, then we can go about deciding as to what to do further. That is called further audit procedures, which we discuss in 330. I hope you are getting the clarity as to step by step what we are doing. So while we develop an audit plan, first let's plan to do 315, which is about risk assessment procedures. Based on the assessed risk of material misstatement, we will go ahead and discuss the further audit procedures as per 330, which are nothing but in the nature of compliance and substantive procedures, which should be the last part of today's session. What we are discussing, we will get to the closure where we do compliance and substantive procedures, wherein I will explain you the entire flow once again. So we have developed the audit plan based on the audit strategy that you have established, and more to this, after you do 315 and 330, whatever other standards are required, there are so many other standards, right? You can comfortably perform whichever standard you actually need. So considering all this, I think this is a major part. So going back here once again, let me try to explain you that quick idea of recurring audit. In recurring audit, we're doing two things. One is preliminary engagement activities, wherein you're doing these three steps. Two is planning activities. Planning activities are further broken down into these two: establishing an whole audit strategy and developing an audit plan. We have done this. Now what is left over is the other piece. You will do all of this again in a initial audit. In initial audit, apart from doing all of this, you will also, that is in addition to what you have done here, an extra step. What is that? This is called additional considerations. Additional considerations in your initial engagements. So when you take up the initial engagement, so you will do everything of what you did in recurring audit. Everything of what you did in recurring audit plus these two additional considerations. Remember, sometime back we discussed this term called continuance of client relationship. Now, to be very honest, continuance of client relationship doesn't make any sense for a simple reason that this is the first time you've taken up an audit. So when this is the first time you've taken up an audit, how will you use the word continuance? So that is exactly why we're using the word acceptance of a client relationship. Now, if this is the initial audit that you have taken up, then you will have to use the word acceptance of client relationship. But the same 4 points, would you check there? That is the same 4 point that you will check here. But this time we're talking about acceptance of client relationship. Then communication with predecessor auditor or previous auditor. Right? It's a very important thing. This is an ethical requirement. If you are not doing this, you will be guilty under clause 8 of part 1 to schedule 1 of the Chartered Accountants Act. You will be guilty because communicating with predecessor auditor is something that we need to actually do for a simple reason that it is a matter of ethical requirement. Okay, so and what we communicate, we will just communicate the fact that we have taken up the audit in which they were considered the predecessor auditors, they were as the predecessor auditors. So we'll just have to ask them that is there anything that will preclude us from taking this assignment? That's it, that is stop us from taking this assignment, because whether to respond or not is their choice, but our duty is to just make a communication, and that is exactly why we are making this kind of a communication. So this is the overall picture of what we do in standard number 300 as to planning an audit of financial statements. Now, okay, where do we stand in our timeline? We did standard number 210, SA-300, right? This was followed by SA-300 part 1. Now that was because we discussed and decided about how to do knowledge of client business, and both these were called what? Preliminary. Both those were called preliminary engagement activities. Now let's get to the major part here, planning and risk assessment, which is what you're doing now. Planning and risk assessment procedures. But before we go to 315, we did stand number 300, which explained about planning. So now is the time for us to understand the concept of materiality as part of 320, and then come here do risk assessment procedures based on 315. Okay, so this is what we actually are supposed to do in terms of what we will be doing actually in risk assessment procedures, and then this will be followed up by further audit procedures. This will be followed up by what? Further audit procedures. Now wherein further audit procedures, they're discussed in 330, as in called as compliance and substantive. So these are all the points that we are supposed to discuss. I hope you're getting the picture right now. So these are called preliminary engagement activities which we have completed. This is 300 we've discussed. So should I move on to 320 on materiality, wherein we will do 320, have an understanding of materiality, so that will help us to start the audit, whereby using the concept of materiality we can understand whether the financial statements are free from material misstatement at a later point in time. So what constitutes to material is a very important factor. So let's now talk about materiality. So these are some very important concepts, guys. Materiality, let's deal with this, right? As a matter of fact, as in materiality, what items are material? Those items, materiality or material items, are those items which affect the user's judgment. Items which affect the judgment of users. Judgment of users. That's what is called as material items. So what items are material? If somebody is asking you, material items are those that which affect the judgment of users. As part of this, standard number 320 is what we deal materiality with. Okay, so what items are material? All those items which affect the judgment of users, the decisions that they take based on what they see in financial statements and which influence them, they are all part of the concept of materiality. So we need to now understand one very important point about materiality, which is nothing but materiality is not just going to deal with size of an item, it also deals with nature. These are some points that I want you to keep in mind very strongly. Materiality not just is bothered about size, but it's also about the nature, because one of the most important conclusions that we derive at the end of the story is even disclosure, sometimes non-disclosure of material item. Now non-disclosure of material item can't be quantified, right? But how material is it? So something like that is to be analyzed, which is very important. So materiality is affected by two factors, which are the size and nature of the misstatement. Size and nature of the misstatement. Then one more important point about materiality is the levels at which materiality is discussed. Now materiality is discussed at overall financial statement level, and also for individual class of transactions, account balances and disclosures. And most of you have seen this word as nothing but assertion level. Okay, so the two levels that they're talking about materiality being set are, one, the assertion level, and the one, overall financial statement level. So please understand, materiality is something to do with the seriousness of an item, right? How influential it is in somebody's decision. That's what materiality is all about. So this is a very important point that one needs to consider. Items which affect the judgment of users, size and nature of the misstatement, and also it is discussed at two levels. And one more point that I would want you to also understand is materiality is defined in two stages. Materiality is defined in two stages. What are the two stages? It is used in the planning stage. And it is also used in the performance stage. Guys, as I told you, if you're if you're getting comfortable with things of what I'm saying and understanding it, it's also better to parallelly make notes. Okay, so if you haven't done that, this video will not go anywhere. After it's uploaded, it will definitely be there only. So if you want to come back and make some notes about all this, yeah, keep it this, because going back and reading the content one day before the exam from the main book is a big challenge, right? So we need summary notes, we need quick revisions, quick references. These are things. No, if you have enough time and you can plug in your earphones and listen to all this, you can afford to do that if you are, like very peaceful at mind. But if you want something always to be seen and read, now some people have the practice, they have to see the book and read. That's what gives them comfort. Nothing wrong. So that's why I suggest you make summary notes. Okay, right? This gives a preliminary picture of materiality. So before I step into understanding aggregate value of misstatements, one last time, materiality is affecting something that affects the judgment of users, size and nature. Two levels: overall level and individual level, and two stages: planning and performing. Moving up next is a very important topic called as aggregate value of misstatements. Aggregate value of misstatements. Now guys, this term aggregate value of misstatements, you've heard it as aggregate value of uncorrected and undetected misstatements, right? So this aggregate value of uncorrected or undetected misstatements is a basket of three things, right? Remember, this is a basket of three things. As when you find a misstatement, throw it in the basket. If you ask me, sir, what all will you throw here? Right, the contributing factors to this basket of aggregate value of misstatements is: 1. Misstatements which are identified by auditor. Misstatements identified by auditor. And this is what he did during the audit. Misstatements identified by the auditor during the audit. Plus, what else will form part here? Misstatements which are uncorrected. Misstatements uncorrected, not identified by auditor. Now you may ask me, sir, if it is not identified by auditor, how will it fall here? So please understand, just because you didn't identify doesn't mean it's not a misstatement. You did sampling procedures. Now what if it's not covered in the sampling part? So there may be several misstatements which have not been identified by the auditor, but they are also part of misstatements. And what if some of them turn out to be material? So therefore, misstatements uncorrected, that is also a piece that one needs to consider in this context. Misstatements identified by auditor, uncorrected, not identified by auditor, plus the third one is nothing but the net effect of uncorrected misstatements of prior years or previous years. If there are any uncorrected misstatements of previous years, they haven't been rectified yet, the uncorrected previous years, so those are also taken into consideration. Got it, guys? It's a very important concept called aggregate value of misstatements. Now you may definitely ask me at this point of time, why are we discussing about aggregate value of misstatements? Because right now the aggregate value of misstatements is a very important consideration for us to check whether material misstatements are there. But that does not happen here in 300, that happens in 450. Standard number 450 is all about this. Which one? A comparison between what and what? Comparison between aggregate value of misstatements, plus, or sorry, versus aggregate value of misstatement versus level of materiality. So aggregate value of misstatement to the level of materiality, that's what you're going to use to obviously cross check what exactly are material misstatements. So that is what is going to happen in that particular standard in 450, right? So what items are material and what's aggregate value of misstatements? And moving further, we have a very important concept which is from the standard, which is called materiality in the context of audit. Materiality in the context of audit. So which is also something wherein three items: misstatements including omissions. Misstatement including omissions are material. All misstatements including material only when if they affect the judgment of users. Okay, misstatements including omissions are definitely material if they affect the judgment of users. 2. Misstatements including omissions are material if they affect the judgment of users. And 2. Judgments about materiality. Whenever you are judging about materiality, you always take into consideration two things: size and nature. These are the two things that you always take into consideration. And 3. Whenever you're talking about materiality, it has to be spoken about in common consideration for financial statement users as a group. Consideration of common financial information needs of users as a group. So take all the users as a group, because you can't start discussing materiality for one person this time, one person that time, and all that, right? So it's always a challenge, and this is exactly what you're supposed to do. So keeping in mind 3 items: what are the materiality in the context of audit? Misstatements including omissions are material. Judgments about users are material when you consider the size and nature of the misstatement. And then materiality is common consideration of financial statement of the users as a group. So this is exactly what you need to consider while you talk about materiality. Not only that, you got to make certain assumptions about users, right? 4 assumptions about users. Assumptions are 4 in number. You make assumptions that 1, they have reasonable knowledge of business. Reasonable knowledge of business. 2, what they have is they understand how financial statements are prepared, presented and audited. How prepared, presented and audited. So reasonable knowledge of business, how financial statements are prepared, presented and audited. And then you also need to make them understand the inherent, you also assume that, they understand inherent uncertainties. So assumptions are that users understand or have reasonable knowledge of business, understand how financial statements are prepared, presented and audited to the levels of materiality, and they understand inherent uncertainties involved in financial statements preparing, that they have judgments and all that. And they also understand and capable of making what? Reasonable. They're capable of making reasonable economic decisions. So if you ask me, sir, is it not too much to make these many assumptions about the users? Definitely. But then if you can't make this assumption, you are going nowhere. Okay. So these are the assumptions that you have to make about the users. So now you have only one bunch of users called the group of users, for which these 4 assumptions are there. And now you will set up one solid thing called materiality at financial statement level as a whole. And then you will also set up materiality for individual class of transactions, account balance and disclosures wherever they are applicable. At this point, the last concept that we would want to discuss in materiality, it is called benchmark materiality. It is called as benchmark materiality. It is nothing but expressing materiality as a percentage of a chosen benchmark. That's the definition. Chosen benchmark. Expressing materiality as a percentage chosen benchmark. If you have to pick it up in my language, it's like dash percentage of dash. So in the first dash, you take whatever percentage you want, 1, 2, 3 up till so on, whatever number, dash percentage of. In the second dash, now herein in the second dash, you can take anything. You can take profit before tax, you can take turnover. These are all called benchmarks, right? So these are all something that you will take into consideration. Profit before tax, turnovers, or fixed asset, anything, whatever that suits that particular entity, you can take the second. So if you ask me a question, sir, what will be ideal to select in the second dash? Okay, so to select in the second dash, the last part of discussion, factors, factors that affect the benchmark. So if you're having the book right now, guys, you can mark 2 stars to this question. 5 points are there, they're very important. So factors that affect the benchmark, 1, what part of the elements, you have to cover all elements of financial statement, that is nothing but the balance sheet, P&L, cash flow, notes and all that, all of those, right? Balance sheet, P&L, cash flow. So you're talking about assets, liabilities, income expenses. You got to cover all elements, choose which one it is the one. Then the second factor that you will be considering is items which draw attention of users. Items which draw the attention of users. You have to consider all those items that you believe will draw the attention of users. And three, you will also consider the nature of entity, because what sort of an entity it is, and life cycle stage, where it is in the life cycle stage, right? Or is it in introduction growth, or is it reaching maturity? That also depends. No, the new companies, very introduction companies, you can't take some metrics like fixed assets and like returns and all that. They're not well established, right? So you can take some profit oriented companies, you can take profit before tax. So like that, depending on the entity's nature and life cycle stage also, you can decide what to take. So that, and then very important point, the ownership structure, how it is owned. That is also something that you can understand based on how is it financed by so much of equity, or is it only debt that is taken care of and all that. And most importantly, relative volatility. Relative volatility. This is a very important factor, guys, relative volatility. So that's what takes into consideration factors for determining what the benchmark is. And now one of the points that you generally are asked all the time is revision. Can we revise materiality? Definitely, why not? If revision of materiality during the audit, yes, very much possible. So I'm saying a yes, it is possible. So if you get to know something which you must have gone that time only, like if you become aware of something, had you known before, you would have caused you to set up a different level of materiality, then you can revise that, not a problem. Revision as audit progresses, that's what it is called. Okay, so you can always revise materiality and bring back a new level of materiality as you understand and get idea of new things, right? So that's the next very important standard called as 320 on audit materiality. So I hope you understood the context of what three pieces that we discussed here. I think we'll put up an exclusive session for 315 and 330 together, also highlighting the importance of compliance and substantive procedures to be followed up, right? So we will do that in detail. So I thought we will do a stretch of all. So let's keep this session short actually. Then in the next session we will do one thing. We will do 315 and 330 out. And then also in that session we will discuss the basic fundamental facts about audit evidence, so that we can see the audit evidence standards in the upcoming revision session. So I hope this pretty much sums up what you have normally in obtaining knowledge of client business, planning, and totally having an idea of materiality. So these two sessions, the first one and this one, these put together the first two chapters for the new syllabus. And of course the relevant standards are almost the same in the old syllabus. So whoever is watching this video, old or new, content and concept doesn't change as such. So you guys can follow it, right? So like I said, I think it'd be too much to rush through all the standards and quick revision. So we'll do one thing, we'll go in parts, right? So in the next segment I will be discussing 315, 330 in detail as to understand what the risk assessment procedures are and further audit procedures are. And then we will also take an insight of audit evidences, so that we can understand what sort of audit evidences we can be using, and what is an audit evidence. We'll go right from the definition, try and understand what exactly we will do there. Okay, I'll see you soon in my next session, guys. Thank you.